Stocks hang in there after a blowout non-farm payrolls print takes front-end yields higher, pricing in a higher chance of another 75 basis point hike in September. VIX still feels heavy, but is running out of downside, and oil breaks below its 200-day moving average support as demand destruction weighs on prices across the entire energy complex. All this and more this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is the 9th of August, and let's take a look at these markets. Right, so last week, really it was all about that jobs data. So we had a stronger ISM services midweek than expected, which the market kind of took well. And then we had that US jobs data that really was blowout number from non-farms, led to an aggressive bear flattening in the curve, taking the 2-10 yield curve close to negative 50 basis points, which is a cycle low. And then the initial knee-jerk reaction was obviously for equities to sell off, as you would expect, pricing in more hikes, kind of the good news is bad news dynamic that we've been seeing of late. But then, true to form, equities managed to kind of crawl their way back. Yeah. We bring up the old vol-adjusted moves. We can see the 2-year US up 2.5 sigma. So that was kind of the biggest move that we saw in the rates curve. As I said, we were seeing bear flattening. The dollar also bounced. We had said, reaching that lower end of the range at 105 in DXY was likely to find some support, and it kind of found that with the better data out of the US and that move in rates. And we also saw dollar yen reverse violently, right? Dollar yen was threatening to break down, taking out that 131 area to the downside as yields were moving lower. And as yields reversed and went back up again, dollar yen reacted and had a strong bounce, basically. And that took the broad dollar higher as well. Energy commodities took a beating, with oil breaking its 200-day moving average. Nat gas also down. And then metals continued their comeback. So seeing decent moves out of the likes of copper and silver to the upside. Finally, crypto markets gained as risk assets have held up as we approach the next Ethereum catalyst, basically, right? So generally, that correlation's back again, and we're getting a bit more positive news flow coming out in crypto, which we'll talk about in a bit. Okay. If we then, look at sort of one of the reasons for the rally was just the bearish sentiment we had said. And that was triggering a short squeeze. And now if we look at some of those metrics and those indicators to see where things are now, some of those sentiment indicators are actually now going back the other way and showing a bit of overbought market, basically, right? So you got this Morgan Stanley sentiment indicator has gone from, oversold territory to looking potentially overbought. You've got put call ratios coming back down, not at the lows, but well off the highs and closer to the lows. So it's a bit of complacency coming back into the market there when you have put call ratios low like that. We've got the macro hedge fund performance. You can see the correlation to the S&P from macro hedge funds has been very negative, showing how underweight these guys have been. And they have partly been cutting some of that negative delta or that negative beta to the market, which has driven some of the squeeze. That may still have room to run. We also know that, but if they are doing that, if you look back at this kind of AAII bull bear indicator, so far this year, if you've chased bounces in this thing, you've got your ass handed to you, basically, right? So, 3 times now, you've had a decent bounce in this indicator from low levels, and the market has obviously squeezed and then just violently sold off after that. And question is, is it going to be different this time? I highly doubt it. I wouldn't be chasing the market here, right? I know some people have felt the need to reduce shorts and stuff to kind of get closer to home so that they're in a position to redeploy shorts if the squeeze does continue. But, if you size yourself well, then and you can stay in the short, that's the way I'd prefer to be in it. I don't really want to be buying back my shorts here, and I haven't felt compelled to, because I've kind of sized it okay. But really, that's what it all boils down to, right? Sizing your shorts so you can stay in the game, right? But if you have a longer term time horizon, like 6 months plus, I think economic gravity is going to kick in, and I don't see how this market doesn't go lower, basically. Yeah, we know that we've got the corporate buybacks back on the table. We know we've got the systematic buyers buying it as realized vol comes in. But at some point, realized vol kind of reaches a bit of a low. That kind of tailwind to the market kind of goes away, right? As those systematics have addressed their underweight and they've re-leveraged themselves to a lower level of base volatility, then that bid gets taken away, basically, right? So that's kind of, I think, I don't know if we're quite there yet, but I don't think we're a million miles away from that point, basically. Yeah. Okay, so that's kind of sentiment and positioning. We then look at kind of what happened to the rates curve in a bit more detail. And this is something we discussed in our roundtable last week with the boys. For those of you who haven't watched it, I recommend you check it out on our YouTube channel, Q3 Roundtable. But basically, this is something me and Andreas were talking about, which is the 2s, 10s, how much could it flatten, right? And whereas people are looking at it at -50 saying, well, I can't enter the trade now. Well, if you go back more than 20 years and you go back to the 80s, 70s and 80s, this thing, and that's probably the closest backdrop, macro backdrop to what we are in right now, this thing got to negative 200 basis points, right? So you need to know that, and know that in the context of that, you know, we still could have a lot of room to go where the front end gets stuck because the Fed are having to address spot inflation and these incredibly high prices right now, and the political mandate that they have to try and get that under control. Whereas the more they push right now and take rates higher into a slowing economy, the bond market's going to respond and is going to take long end yields down, basically, right? Inflation expectations have obviously rolled over, which has supported long-term bonds. Many smart macro guys are now calling for long TLT as their main trade. You know, obviously Raul's been saying it for ages. Alf and Andreas have added bonds into their book. Now you've got this guy, Teddy Valley, I believe, who's done pretty well this year, has been recently on the tape saying he's long bonds as well. So quite a lot of people are happy to get long bonds now. And apparently, according to this guy, Teddy Valley, you know, he sees bonds as kind of dislocated from every other macro asset, which is pricing in weaker growth. But you think bond yields are still elevated because QT's on the table. And so there may be, you know, 100 basis points repricing needed in the long end once that market kind of catches up to reality, right? That's kind of his view. You know, if growth data rolls over fast enough, then the Fed might slow down on QT, and then we might see those back end yields really start to come off. Okay. Right now, though, the safer trade, knowing that you may still see high inflation prints, looking at the acceleration of inflation, particularly sticky inflation, not food and energy, but the stickier stuff like wages and rents, things like that. You know, that's why I think the flatten is working so well, right? Because people want to own the long end of the bond market, but they're scared to own it naked, so they're selling front against it, basically, right? And that's why that flatten has performed so well, I believe. Yeah, it's your way of expressing your weaker growth outlook, but not getting run over by like really high inflation data that might print over the next couple of months. What else you can see? Obviously, the non-farm print has quite dramatically repriced the front end expectation. So, you know, a week ago, we had a 70% probability of a 50 basis point hike. That's flipped the other way now. And we've got close to a 70% probability of a 75 basis point hike, right? So that's happened since the non-farm payrolls came out, basically. And like I say, we can see here in the charts, we've got inflation expectations rolling over. We've got TLT forming a bit of a base here. Reasons why people are getting a bit more comfortable getting into the long end of the bond market. Yeah. My personal, I've got a little bit of allocation to TLT in my pension, and I've sold tactical front end euro dollar futures in deck 23. I do have some of those low delta call spreads on just in case that front end really does fly, which I had on for ages, but they don't expire till December. But in terms of tactical, when the market priced after the FOMC, when the market went nuts and just got really dovish, I couldn't resist selling some of that front end deck futures because against my longer term pension holdings in TLT, because it just didn't make a ton of sense to me that the Fed was going to let the market price in such a dovish outcome based on going data dependent, basically, right? And we've seen the Fed speakers come out in force trying to walk that back over the weekend. So yeah, it seems like they're not happy with the financial conditions easing that happened as a result of what Powell said at his press conference, basically. So that's kind of what we saw in rates right now. If we move over to what's going on in terms of the market and what S&P price action, and I've just kind of flagged the things that kind of triggered various price swings. You had the ISM services beat, where you had this kind of collection of green bars taking the market higher after it sort of bounced off like that, just under that 4,100 area, which is now quite a major support from the likes of Spot Gamma, calling it the vol trigger. You then traded sideways into non-farms. You had that drop on non-farms, that knee jerk to the inflationary data that moved the rates market. But after that chop, equities kind of managed to recoup most of that, or at least half of it. And then over the weekend, we kind of gapped higher. Now, that was partly on the back of this kind of Inflation Reduction Act passing through the Senate, a form of stimulus, basically. So I think that was partly why we kind of opened up, quickly faded. NVIDIA missed their earnings quite dramatically. I think the stock was down, 8% or something like that. I don't know where it finished. But basically, that kind of took the wind out of the sails of the market. So that hit the NASDAQ. The meme stocks did rip like crazy. So that's probably a good selling opportunity, to be fair. But again, one of those things you probably want to do via optionality. So something like AMC, for example, I might look at put spreads or something in that to fade that move. That's usually quite a good strategy when the meme stocks go nuts. But basically, yeah, like I said, NVIDIA, and then generally, the market kind of getting primed for CPI, ready for what's happening there. And given the hawkish Fed speak that we're getting, not a major surprise to see the market under a bit of pressure. Add to that some of the geopolitical tensions that have been coming out with the likes of Turkey, increasing their economic ties with Russia, what's been going on with China, Taiwan throughout last week, and how China are responding and increasing their kind of military presence around the area, and their military exercises. It's kind of their show of force, basically, and that's creating a bit of tension between China and the US, right? So these are all things that are slightly weighing on the market early this week, basically. Yeah. Okay. If we then have a look at what I'm seeing in sort of VIX and option space, bring this chart up here. So obviously, the VIX, I've been thinking the VIX was headed lower, whether the market managed to rally or not. I just thought market's probably going to be a bit range bound and well supported by some of these systematic flows. So realize should kind of continue to, chill out a bit. And then if that happens, I think there's scope for the VIX to get whacked. So obviously that was when the VIX was in the mid 20s. VIX has got down to the low 20s now, but the major support zone I'm really eyeing up on the VIX is 18 to 20. Whether we get in there or not remains to be seen. I'm kind of hopeful we do, but we kind of need the S&P to hang in there and not break through 4,100 really for that to happen. VIX expiry is next Wednesday, so we've got a bit of time. So if the market can manage to kind of hang in there this week, then there is scope for the VIX to kind of test that zone, right? You guys obviously know I bought some VIX 22 puts that expire next Wednesday. I don't generally like to run these things into expiry. So if they kind of, there would have been a great opportunity to sell them at the open yesterday, but I didn't take that opportunity. I think they traded as high as 120 and we bought them at like 30 cents. So that's a 4-bagger. I didn't get out of them at that level. I'm obviously short S&P calls against them because it was a relative value trade, not an outright trade that I did. So far, the trade's behaving itself, right? I think the VIX puts went from 30 cents to 65, 70 cents. And I think the S&P calls went from 20 ticks to 45 ticks, right? So very similar in terms of what they've done in terms of percentage increases, right? So no real damage done on that trade. But that trade really will clean up if the market can kind of just grind its way to 41.50 and kind of gravitate there over the rest of this week and realize comes off and VIX comes off, basically. Like that's where that trade can make money. Otherwise, on the upside, a sharp upside move or a sharp downside move, I don't expect the trade to do much, basically, right? So that's kind of, but by Friday, I'm probably going to be getting out of that VIX trade at the very least. Maybe I'll stay short the calls if I want to use them as a way to be bearish S&P. Or I might, depending on the pricing and my thoughts on how steep the curve is, I might roll those August 22 puts into September if the pricing looks sensible, basically, right? That might be another way to extend the life of that trade and play that relative value if I think there's juice there. Now, the motivation for doing that would be, you look at the roll yield on VIX, right? So the curve here, you can see August at 22.5, September's at nearly 25. So arguably, if VIX just stays at 20, there's 5 vol roll down from the September contract to the spot VIX, basically. Now, chances are VIX isn't going to just sit there at 20. It's probably going to go higher as we approach September FOMC, because that's going to be touted as a big deal. So VIX might drift back up to price some of that in. But just to be aware, that roll yield is pretty juicy right now. And on that point, that's what makes VIX futures quite an expensive thing to own right now. So if you're looking for bearish expressions, you're thinking, you know, VIX is kind of floored at 18 to 20, so there's asymmetry in buying the VIX. That may be true because the VIX might not have loads of downside, but that doesn't mean the VIX futures in September haven't got this beastly roll down to contend with from 25 down to low 20s potentially, right? So that's what makes that a hard trade to carry. So what I'm seeing in the VIX market, well, the big flows that I saw at the back end of last week, and I can highlight it here. This thing here, can I draw on that? That is showing a lot of open interest building in the likes of October, November, September, in the 70 strike area, right, on the VIX, which is miles out of the money, okay? So you might say, you know, why are people wasting their money buying the 70 strike calls when the VIX never does anything? Well, the subtlety there is what they're actually doing is they're selling this area against it. So they're selling the 35 strike calls to buy 3 or 4 times the 70 strike calls. And they're doing that in maturities like September, December, November, whatever it is. So what they're really doing is they're putting on a volatility position on the VIX. And what they're saying is, yes, if the VIX gets back to the high 30s where we've seen it before and it hasn't managed to break, then no big deal. Nothing's going to happen. But if it breaks 40 and the market really starts to go, then the vol that you own on those 70 strikes could be really explosive, right? So that's a way of owning the crash, kicking into a shitload of VIX and vol of VIX, so VVIX essentially, right? If the market was to crash and the VIX was to go through 35, 40, okay? And the reason why it looks attractive right now is because there's an alternative to holding VIX futures that have got a really heavy roll down. You don't have to stomach that roll down because it's probably quite a delta neutral structure. And then the skew on the VIX is about as flat as it's ever been. So in that trade, you're a net buyer of vol, which is the VVIX essentially, which we know is quite low, right, historically. And you're also a buyer of skew on the VIX because the skew is to the upside on the VIX. And that, again, is quite low versus where it typically trades, right? So you're buying these metrics, you're buying this risk premium at very low levels relative to where it's been. And the idea is that if nothing happens on the VIX and it keeps rolling down to 20, your positions are not on the map. But if the world starts to change and we do melt down, then this stuff starts to come alive and it can reprice in your favor because it's coming from very cheap levels, basically, right? So that's the idea. I just thought I'd flag that in terms of what flows that I'm seeing there on the VIX, basically. And like I said, I do see some merit to those trades. So it's clearly vol savvy people that are putting on those trades, basically. And zoomed out a bit here, see where the major support zones are. For me, you know, we're coming to a bit of a confluence of support zones, right, down here. So it did sort of feel like oil's running out of downside a little bit, which is what made me comfortable kind of dipping my toes in. And I bought a little scrap of futures and I sold a little scrap of puts down here because I don't mind starting to get long, given the confluence of longer term supports that we're seeing, basically. So I still believe that the longer term trend is in place. You know, macro data surprises to the upside suggest the imminent recession might be delayed as well. So that would be supportive of prices. SPR reserve releases are also due to stop in October. Which arguably should have a positive price impact as well, right? If the SPR reserve releases had a negative impact and kept the lid on prices, then you'd like to think the opposite is going to happen when they stop doing that, right? So, you know, potentially some support coming in for the oil market. Now, the reason the oil market has been so weak, though, is this demand destruction concerns, right? And there has been a fair amount of evidence of demand destruction if you look at some of the data. But, as I already said, some people are claiming that this data is a bit bogus. I wouldn't know whether it is or not, so I wouldn't like to speculate. But if you look here, the jet fuel and gasoline sort of numbers compared to pre-COVID levels, are showing quite a lot of shortfall in terms of demand this time around. We've also got Chinese oil demand has come off quite considerably from its highs. Looking back, this looks like, what is that, quarterly or monthly? I'm not sure. But basically, it's rolled over quite a bit on the back of what they're doing to their economy and not letting people out. And then you've got, obviously, the recession fears that were apparent maybe a few weeks ago, less apparent now maybe. But you look back at all the past recessions, and oil, doesn't tend to escape them, right? So if you do think we're headed into a global recession, then it makes sense to get. Now, having said that, oil's gone from 120 to 90. That's already a pretty decent drawdown, right? Is it enough? Who knows? Gasoline prices at the pump in the US are down about 25% as well. Will they bring some demand back so people might come back and start going places over the summer if they haven't been? So, you've kind of got this to and fro between prices and supply and demand. And if prices come down enough, then demand's going to come back up. I suspect that's probably what we're going to see. Prices probably have abated a bit now to bring some demand back in. I don't think the demand in energy is quite as elastic. There's obviously been people putting out various pieces of data around that point. But yeah, in general, people are going to need to use energy, whether it's for leisure or whether it's for manufacturing. And unless they put caps in place like they're doing in Europe, where you literally aren't allowed to use as much energy as you need to, I would have thought in the US, the demand is going to come back, given that prices have come back a bit, basically. Yeah. So that's kind of it on oil. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.